So today we're going to start with a word that we call capitalize. I don't know if I'm spelling it right, but who cares? This isn't English, ne? Capitalizing. So what does it mean? Basically, when I use those two words, I either work with loans, ne? But let's just start with the loan, or fixed deposits. Now I'm first just going to explain loan to you. So when I make a loan, now let's say my loan has a balance, I make a loan. How does a loan work? So a loan works like this. I go to the bank, I apply for the loan. When I apply for the loan, I need to give them certain documents. It's the same as when a debtor applies for debt to buy on an account. It's the same things. ID, bank statements, salary slips, proof of residence, ne? All of those things. Now the bank says, yes, you may have the loan. What happens? You'll hear an SMS on your phone because you have notified me. That money has been deposited into your bank account. Can you see this is an inflow of cash? Now I have 100,000 rand in my bank, but I have a loan which is a liability. And this 100,000, my original amount that I borrowed, I call this a capital amount. This is my capital amount, meaning my main loan amount. Okay. Now I know if I want to have a loan, what's going to happen? I have to pay off the loan, right? But I don't just pay off the 100,000. I pay off interest. Okay. Now, let's say my interest is 1,000 rand a month. Okay. If my interest, like what you are thinking now, is month 1, I'm going to pay 1,000. Month 2, I'm going to pay 1,000. Month 3, I'm going to pay 1,000. And so it will go on and on and on for 12 months. And in the end, my expense for interest in loan is 12,000. Okay. Now, can you see this has no effect on the capital amount? In other words, the main amount I borrowed. Can you see that? Now we call this process here, we say the interest is not capitalized. So can you see this weird word, capitalized? Meaning the interest is not made a loan. Okay. So, because what happens is some people would make an arrangement with the bank, ne, where the interest is capitalized, meaning they make the interest part of the loan. Okay? Why would they do that? So that they can also start paying off on the interest. Maybe they don't have enough money to pay the full interest every month. So they make it part of the loan agreement. So now they're going to start paying off the interest as well. But can you see what's happening? If I capitalize my interest, okay, so let's do the process interest on loan, where I capitalize my interest. I'm not going to pay them that 1,000. I'm going to take that 1,000 to the loan. And this process, this, I call capitalize. So I make the interest now part of the loan. Can you see the difference? So the one where I do not capitalize it, I will, in other words, just show if I pay back on the loan. I will show separately that I pay the interest on loan. The moment the interest is capitalized, I take that interest and I now make it part of the loan. Okay? In other words, if I pay my loan now, let's say I pay 1,500. Can you see what the bank is going to do? is they're going to say, oh, you know what? Your interest is 1,000. So from that 1,500, we're going to take 1,000 for interest. And you will only pay 500 off the balance. So in other words, they will always, from whatever you pay, first subtract the interest. And what is left would be paid back on the loan itself. Okay. In other words, can I tell you, my loan, my home loan at this stage, I pay back every month 12,300. That's my installment. Ne? From that 12,300, 8,700 is interest. Can you see why a home loan takes 20 to 30 years to pay off? Because you actually, the first few, let's say the first 10 years, your installment, the biggest part of your installment is interest that you are paying. It's a very small part that goes off on your loan itself. That's why, let me go, it's still on the topic, but just interesting. They say the best way to save is when you buy property and you got a 20-year loan. The day you receive that loan, you pay the first installment. Can you see then the loan hasn't started running interest yet? Ne? So then that full, if I paid the 12.3, that full 12.3 would have gone off on my loan immediately. So immediately my capital amount that I borrowed is now immediately less, meaning my interest is immediately less. Meaning from there on I pay a little bit more on my loan every month than I would have if I didn't start paying back immediately. Does that make sense to you? Sort of. So now, when we do this, I'm not going to do the not capitalized, because that does not exist in the real world for loans. They automatically capitalize. So now I'm going to show you a little song. So, basically, if I look at my loan account, my loan account has got an opening balance. Ne? Now, if you look at your loan T, there's things going to happen, and then I'll have my closing balance, which will be next year's opening balance. Ne, Miss B? Okay. Can you guys see? I start with my opening balance. Let's say I borrowed 100 rand. Okay? And I have a closing balance of 80 rand. Which means, can you see, I paid back 20 rand on my loan. Can you see that? Because if I had 100 rand the start of the year on my loan, and now the end of the year they tell me I've got 80 rand, then it means I paid back 20 rand. So how will I show it? I will show it here on the debit side, 20 rand. You all agree with me? But now I'm telling you, minus plus. It's a loan. It's a liability. Yeah, remember, I'm just, instead of saying balance CO, remember, balance CO, balance BD, I now just talk opening and closing. So CO is always your closing, and BD is always your opening. Okay, otherwise my song is not going to work. Okay, so I actually only want to work with this year's opening and this year's closing. I'm not going to work with next year. Because now I tell you, oh, you know what? You know what? I didn't pay back 20 rand. I paid back 30 rand. So now can you see this adds up to 110? So can you see this side shorts 10? So that 10 will be my interest on loan. You see? So what they are going to do, if you look at your notes, and I want you to go here, page 13. So now if I look at page 13, First of all, I need you to see this because this is 4 marks in your income statement immediately, without a doubt, immediately. So now when I look at this, can you see they tell me I have the end of the year a balance of 40,000. Okay, but now I want you to see that this is different than the balance they give me here. So just think about it. When I have a T account for loan, I have the balance the start of the year, and I have whatever I pay back during the year. Okay? You guys get me? That's in my books. Now I get to a certain time, so you can have an arrangement. Most banks sends you a bank statement at least 3 times a year. But let's pretend now, in our situation, they send you a loan statement once a year. Now can you see that opening balance is different from the balance in my books? And the closing balance is also different. So where did they get that 40? Now quickly look. If I take that 60, less the amount that I paid back. In other words, my balance was 60. I paid back 20. What balance will it give you?
40,000.
The 40,000. So, can you see this is basically my opening less my bank, gives me that amount in the trial balance. Okay. Now, if I ask you, what is my interest on loan if the interest was capitalized? You're going to sing this song. I'm not going to ask you the loan T account formally. You're going to do it as a little calculation. And my calculation is like this. You got an opening and a closing and a bank and an interest on loan. Can you see? We are cowboys. You want to sing it with me? Now let's look. What is my opening? It's 60. Please stop talking. It's 60. What is my closing? It's 55. Can you see I'm working with the CO, not the BD. This is BD. This is CO, the closing. Okay? How much did I pay back? They say we paid back 20. Right? Everybody with me? So how much is my interest? So, can you see? 60 less 20 gives me 40. Less 55 gives me 15 on this side. Or I can say this adds up 75. So 75 less 60 gives me 15. So this is my interest on loan. Meaning my interest on loan that goes to the income statement is going to be 15,000. So can you guys see how this works? Now, let me quickly show you. What is the difference between the opening and the closing? If I take the difference here, how much is the difference? 5,000. Can you see I paid on the loan 5,000. What is the interest that I paid? They tell me there, 15. What does that add up to? Can you see that gives me the 20,000? So in other words, that payments that I made, this one here, is the payment on the loan, meaning the opening less the closing, and the interest. So I want you to quickly see. If I take that 40,000, how will I get the closing balance? What is the closing balance? 55.
You can add the interest.
I just need to add the interest. Then I get the closing balance is 55. Can you guys see that? You can play around with this quite a lot. Okay? Yes.
What are the symbols?
Oh, let me quickly go through the symbols. So O stands for opening balance. In other words, your balance BD, the balance the first day of the month. C stands for closing, meaning balance CO, because it's going to be still BD here on the credit side again as an opening balance next year. And this is the end of the year, the 30th of June. Okay? B stands for bank, because that's what I pay, interest on loan. Okay? So, when I abbreviate, I will literally say OCBI. Okay? You guys fine? So, I just quickly want to go through this with you. I want to ask you, when I do the income statement, and this is very important for Friday's test, when I do the income statement, my interest expense, which is most of the interest on loan and other interest like interest on bank overdraft, interest on overdue creditor, ne? It's going to be a bracket how much? It's always the profit and loss, ne? It's always that profit and loss that goes to the income statement. So there will go the 15,000. Okay? Okay. In the balance sheet, now in this case here, they didn't tell you what your short-term loan is. Now let me just give you a little information. Let's say, for instance, I tell you, we pay back how much should we pay back? 5,000, the same next year. So now, they can tell me I pay back 5,000 next year, I pay back 20,000 next year, or they can say I pay back the same. What did I pay back this year? That's the same. The opening less the closing, 5,000, right? Now, if I go to the balance sheet, my non-current liability, loan, and you guys, please, I see you're not concentrating. So I hope you're going to listen to this again. You're going to take your closing less short-term loan. And what is your short-term loan? It's the part of the loan that you're going to pay back next year. In other words, it's that part which they told me here. That one there will be this information where they tell me what I'm going to pay back next year. You see? So now let's quickly go look. What is my closing? Oh, it's 55. What is my short-term loan? Same as what I paid back last year. So in other words, my loan is going to be 50. Okay? But now comes another thing. If I go to current liabilities, what is my current liabilities? It's most my payables, bank overdraft, short-term loan. Okay? Now my short-term loan would be that 5,000. That's my short-term loan. And how we mark it in the index in the exams is you'll get a tick for that, a tick for that, a bagel for that, a tick for that, if it's the same.